Hi there. In this video, I'm going to talk about the second part of partnership, which is termination and liquidation. In this video, we will cover first the journal entry of liquidation and termination. Then we talk about the statement of partnership liquidation, and you will see this in the assignment as well, the proposed schedule of liquidation and pre-distribution plans. To make it easy, I prepared some examples for each one of these four objectives to help you to understand the topic and to answer the assignment and the quiz in an easy way. First of all, when we liquidate a partnership, we have to sell all the non-cash assets like inventory, accounts receivable, property, plant, and equipment. All the non-cash assets should be converted into cash. Then we pay all the expenses and the liabilities that might happen during the liquidation time. We pay all the creditors. And finally, whatever is remaining, we give it to the partners. And when we pay the partners, we might face some issues that maybe one of the partner has a deficit balance. It means his capital account is minus, or some of the liquidation might not happen instantly, so we pay the cash to the partners in installments, which we call it safe payments, or we might make it in advance. We call it pre-distribution plan. So in this video, I'm going to cover up the first four items here where we sell the non-cash, pay the expense and liability, distribute the cash to the partners, and we will leave these three issues of the partners for another video. Now, when we come to the liability issue, we rank the liabilities. First, we put a payment for creditors. Then we pay the partners if they are giving loans to the company. So we consider here the partner not as an owner, but as a creditor. But he will get his money second after creditors. Then we pay the liability to the owners, which is their capital, and finally, their portion of profits. So when we pay the liability, we have to pay them in this order. Now, let us have one exercise to show you how we make the journal entries, the cash and capital balances, and the statement of distribution. We have here a simple balance sheet that happened for a partnership owned by Morgan and Houseman, and they are liquidating the company. Remember here, when we liquidate the company, we classify the assets in the balance sheet into cash and non-cash. And here the non-cash is accounts receivable, inventory, land, building, and equipment. On the other side, we have the lump sum amount of liability, which is 32, their capital balance 50 and 38. Now, the non-cash assets, which is $75,000, have been sold. How did we sell them? First, we sold the inventory for $15,000. Then we sold the accounts receivable for $9,000. Then the fixed assets for $29,000. And by doing that, we finished all the non-cash assets. Then we pay all the liabilities. We incurred some expenses of $3,000, which is liquidation expenses. And finally, we cover up all the remaining cash to the owners. So now we need to know what are the journal entries that should be made for those events. First of all, when we sell inventory, we debit cash, credit inventory. However, the inventory in the balance sheet is 22, but we sold it for 15. So there is a difference here that should be covered. Usually we cover them by the capital of the partners directly. Why we don't put it as an expense? Because we are liquidating the company. So any income or loss that might happen during the liquidation, it goes to the partner's account. So we distribute the loss here by 60-40 between Morgan and Houseman. So this is the first journal. The second journal, we collected the accounts receivable 9,000. Meanwhile, the value of the accounts receivable 12,000. So there is also loss here of 3,000 that's covered by Morgan and Houseman. Then we sold fixed assets for 29. So there is a loss here by 12,000, which is covered by Morgan and Houseman. And then we paid the liability. So we debit liability, credit cash. And then we incurred expenses. In the daily life, if we incur any expense, we debit expense, credit cash. But because it's liquidation, we take it off from the capitals of the partner. So Morgan will pay 1,800 and Houseman 1,200. And the last journal is the distribution of the remaining capital to the partner. We debit Morgan by 35, credit Houseman by 28. And here I am sure we might wonder, how did we get these amounts? This is what I'm going to show it in the next slide. But I encourage you to stop the video, go back to the journals and study each one of them, because this is what you are going to see in some of the exercises in the assignment and the quiz. Now, how do we get the balance for Morgan and Houseman? We start by the balance sheet that has been offered at the beginning of the example. We have cash 45, Morgan capital and Houseman 50 and 38. We put them in this table. So this is the table of cash and capital account. The cash 45, Morgan capital 50, Houseman 38. And by the initial look, we see that if we add their capital, is not equal to the cash. Why? Because of the assets and the liabilities. Now we need to build up this cash and capital account. So we go to the first transaction we did it, which is the sales of inventory. We record it here. We record only the cash because it's cash 15. Their capital account was debited. So we put it here by minus, because the initial recording of the capital account is credit. So when we debit it, we put it by minus. And then we continue. We made collection of accounts receivable, which is similar to the inventory. The cash is debit by 9,000 and their balances are credited. So here we put 18 and 12 by minus as we did in the inventory. Then we continue. Then we sold the property, plant, and equipment by 29. And then we made losses, which has been assumed by Morgan and Houseman. And then we paid the liability. And when we come to the liability, it didn't affect Morgan or Houseman account. So we see only the cash, which is credited. So we put it by minus. But Morgan and Houseman capital accounts are zero because they don't show up here. And then we made the expenses. So we minus the capital account and the cash because the cash here is credit. And finally, we add up, we get the final balance, which is here 35 and 28, which I mentioned in the last journal. So to make the last journal correct, you have to do the cash and capital account balance in this sequence. Please, again, stop the video, go through this example because it will help you in several exercises in the assignment and the quiz. The next point in this example is the statement of partnership liquidation. How do we make this statement? We take the same balance sheet, but we put all the non-cash assets into one column, and we put it in this format. So we put the cash, non-cash assets by 75, liability, and the capital accounts. And then we start building up this statement first by sales of inventory, where the cash was debit, the non-cash was credit, and the capital accounts were debited. So here we get it, and here is the balance. Then, so here the inventory, then the accounts receivable. We did the same issue. So we got these numbers from the journal entries. And then we sold the fixed assets. So now the non-cash asset became zero. And the cash increased, the liability remained the same, and the capital accounts decreased by all the losses. Then we paid the liability. So the liability became zero now, along with the non-cash, and we had only the cash and the capital accounts. Then we pay the liquidating expense, which are gonna reduce the capital accounts, and finally we get the non-cash balance. So what we call this statement, the statement of partnership liquidation. And this is the first part of liquidation in partnership, which shows you how to do the journal entries, the cash and the capital accounts, and the statement of partnership liquidation. I hope you find this video useful. Thank you.